The gentleman from South Carolina.
Thank you, Mr. Chairman. Mr. Chairman, it's good to see you. We sent an email out yesterday, Mr. Chairman, to folks in South Carolina, and these are just a sample of the questions that I had for you to be asked today, because people are concerned about what's going on. I'm concerned. I'm concerned about what happened with the Treasury and the implementation of the TARP, oversight, transparency. In the same breath, I'm concerned about the Fed, too. I mean, you guys have spent hundreds of millions of dollars with a lot less oversight. So if you can, Mr. Chairman, let me just ask you a couple simple questions, and I want you to explain these to these folks right here in terms that they can understand. Why, number one, why haven't, after all the stuff that you've done, after all the stuff that the Treasury's done, why haven't the credit markets come back?
Because the financial crisis, two-part answer. First of all, the financial crisis has been extraordinarily severe, and those financial effects are incredibly powerful. And the intensification of the financial crisis in September knocked the economy, the global economy, for a loop, which it is now just beginning to get its feet. So I think that what the actions that were taken prevented a much worse situation, a meltdown that would have led to a catastrophic and long-term low level of activity. So the fact that we haven't gotten back to normal is just consistent with experience that financial crises are very serious matters. The second answer I would make, though, and I would just like to emphasize that all these programs I talked about, the program for consumer and small business lending, the mortgage-backed security program, the interbank lending program that affects LIBOR, all of these things have already shown up as improvements in those credit markets which directly affect people in South Carolina. They are not banks and investment banks. The 30-year mortgage rate affects your constituents. The commercial paper rate affects the company they work for. The rate on auto loans, on student loans, on credit card loans, all those rates will be affected by the programs we're undertaking. We're doing this not because we have some nefarious scheme. We're trying to help the American economy recover, and we're using whatever methods we have to overcome what has been an enormous blow from this financial crisis.
And I hear you, Mr. Chairman. Second question. Do you have, and the Federal Reserve, do you have an overall arching goal that underpins the decisions of when and how you intervene into the market? That's what they want to know. Mm-hmm. And number two, when do you stop? When do you draw a line? When do you say, okay, no more? And I guess that's part of the third question. How much more is it going to take?
So as I've tried to emphasize throughout the hearing, there are two types of interventions. There are the interventions that have involved trying to stabilize systemically critical firms whose failure would create tremendous problems for the financial system and the economy. As I've indicated, I'm very unhappy about having to be involved in those things, and the sooner I can shed that responsibility, the happier I'll be. On the other side, the other type of activities has to do with our expansion, trying to create and stimulate credit markets where credit markets have broken down. And there, we want to keep looking for situations where we believe we have tools that can get the markets working again, that will create lower rates or better credit availability, and will stimulate the economy. I think those things are in the interest of the people, and that it can be explained to them that it's in their interest. But I don't know how much more, but I think given the severity of the situation that we do expect it to expand somewhat more to address the severe dislocations we're seeing in a number of key credit markets, including consumer credit markets.
When you talk about expanding more, can you be a little more specific?
Well, for example, the so-called TALF, the asset-backed securities program, was slated for $200 billion to support new lending in credit cards, student loans, auto loans, and small business lending. As part of the plan announced this morning by Secretary Geithner, the Treasury and the Federal Reserve will collaborate to bring that amount up to $1 trillion, which would be another $800 billion of credit made available to broad categories of consumers and businesses.
Last question, yes or no. Was the first $350 of the TARP spent well?
It was critical to stop the meltdown that would have occurred otherwise in October.
Was it spent like it was sold to the United States Congress? Yes or no?
there was a confusion in the sense that there was an honest representation of the goals of the program to focus on taking assets off the balance sheets, which I believe was an appropriate objective, and we're now returning to it. But shortly after the bill was passed, the global financial crisis erupted. The purchase of assets was not fast enough to address it, and so capital infusion was the only method that would save the situation.
I'll take that as a no. Thank you, Mr. Chairman.